Today, we are going to focus on three topics under finance: interest, banking, and inflation. What is interest? Interest is the amount of money either earned or charged, depending whether the amount is invested or borrowed. If you invest money, you are going to get interest over a period of time. But if you take a loan from the bank, you are going to be charged interest. Interest depends on three factors: principal amount, interest rate, time period. Principal amount is the original or the initial amount of money invested or borrowed. Interest rate is the percentage used to calculate interest. Time period is the length of time for which the money is invested or borrowed. In order to be able to calculate interest, you must be able to differentiate between the simple interest and the compound interest. Simple interest is calculated only on the principal amount invested or borrowed. The interest does not change, remains the same. Compound interest is calculated on the principal amount plus the interest that accumulates every period. The interest constantly increases. It does not remain the same like the simple interest. So here is an example of how to calculate the simple interest. If you invest 8,000 Rand for 7 years at 8% simple interest, calculate the amount of money you will earn over the period of 7 years. The principal amount is 8,000, the period is 7 years, the interest rate is 8%. So the first step here is to calculate the interest. So how do you calculate the interest? We use the interest rate of 8%, 8 divided by 100, the answer is 0.08. 0.08 multiplied by 8,000, the answer is 640. Then the total interest over 7 years is equal to 640 multiplied by 7, the answer is 4,480. Then the second step is to add the principal amount and interest. Total amount is equal to the principal amount plus interest. 8,000 plus 4,480, the answer is 12,480. Then the second example will show how to calculate the compound interest. If 1,500 is invested at 7.1% interest per annum compounded annually, how much money will be in the account after 2 years? In order to successfully calculate the compound interest, you have to calculate the total amount accumulated after each and every period. Here, we are going to calculate how much money accumulated after 1 year. On the first year, we are going to calculate the interest using the interest rate of 7.1. Then the interest is equal to 7.1 divided by 100. The answer is 0.071. 0.071 multiplied by 1,500, we get 106 Rand and 50 cents. That is the interest for the first year. So then we add the principal amount of 1,500 plus 106 Rand and 50 cents, we get the total answer of 1,606 Rand and 50 cents. Then to calculate the accumulated amount after 2 years, we are going to take the amount that's accumulated in the first year of 1,606 Rand and 50 cents. We multiply that by the interest rate of 0.071. Then the interest on the second year is 114 Rand and 6 cents. Then the total amount will be 1,606 Rand and 50 cents plus the interest of 114 Rand and 6 cents. And then the total amount after 2 years will be 1,720 Rand and 6 cents. Then the final concept is inflation. Inflation is the continuous increase of goods and services over a period of time. So the picture here shows that the increase of the price of coffee over a period of time in US dollars. Then how do we calculate the inflation? We use the same method that we use when we calculate the compound interest. This is an example that shows how we can calculate the inflation. So here, Mike buys a 12.5 kg bag of maize meal for 120. If the average inflation rate is 4.7% per annum, calculate what will the 12.5 kg bag of maize will cost in 2 years' time? So the first step here is to calculate how much it will cost in 1 year. In 1 year, it will, or after 1 year, it will cost 125 rand and 64 cents. And then after the second year, it will cost 131 rand and 55 cents. The same method as the compound interest. I hope everything is clear. Good learner.